This is where narratives get loud and mechanisms get quiet. When you hear phrases like going off a cliff or repeating 2008, our job is not to react to the headline. Our job is to ask what phase pressure is building underneath price. In the recent discussion around equities, metals, and Bitcoin, the visible focus is price patterns and sharp moves. But the deeper issue is correlation and forced selling. When markets transition from rotation to liquidation, everything can temporarily become the same trade. That is not ideology, that is plumbing. Our strategy framework is phase-based. Phase 1 is expansion. Phase 2 is compression and rotation. Phase 3 is breakdown and credit stress. Phase 4 is forced liquidity. Phase 5 is stabilization and reset. What we are observing right now fits late Phase 2 with a rising probability of Phase 3. Not certainty, probability. When leadership narrows and then weakens, when volatility spikes create reflex rallies that fail, and when liquidity-sensitive assets like Bitcoin begin trading below major trend structures, that is phase pressure building. It does not guarantee collapse. It changes the distribution of outcomes. Here is the key mechanism. In early stress, investors rotate. In deeper stress, they liquidate. Rotation preserves diversification. Liquidation destroys it. That is why equities, miners, metals, and digital assets can fall together during margin compression. The driver is balance sheet repair, not a sudden change in long-term belief. If this type of structured thinking helps you navigate uncertainty with more clarity, subscribe to the channel. The objective here is not to predict the next headline. It is to build a repeatable framework that helps you interpret regimes as they evolve. Through the next several months, we assign roughly a 50% probability that this remains Phase 2 behavior, meaning choppy rotation, sharp rallies, and sharp sell-offs, without full credit breakdown. We assign roughly a 30% probability that Phase 3 expands, which would likely show up through widening credit spreads and repeated failed rebounds. And we assign roughly a 20% probability that liquidity reaccelerates and risk assets extend higher before a more durable reset. Notice what we are not doing. We are not making a directional call. We are mapping conditional pathways. What would confirm deeper stress? Sustained credit deterioration, funding strain, repeated correlation spikes where rebounds cannot hold. What would invalidate that path? Improving breadth, compressing spreads, stable funding conditions. This content is for educational purposes only and is not investment advice. Our strategy conclusion is disciplined. Respect bounces, but do not confuse a bounce with a regime change. Watch the plumbing, not the panic. Manage probabilities, not conviction. When phase pressure builds, the edge is not being first. The edge is being prepared.